Welcome back to the video. My name is Andrew Kuhn. Focused Compounding Podcast, Focused Compounding website. What else do we do? Focused Compounding Capital Management, and now IGTV. We hope everyone's having a great day. And in today's video, we are going to be talking about insurance companies, specifically insurance stocks.
Okay.
Not to be confused with, I don't even know, annuities. We're talking real world insurance. So what insurance companies have you analyzed recently? When's the last time you analyzed an insurance company?
In terms of a write-up for the website or something?
Yeah.
I can't remember the last time. It's been a very long time. The last insurer that I looked at seriously, well, there was an insurer that does runoff stuff and things, but the last insurer I really looked at was Gainsco.
Gainsco, I was going to say Gainsco. So I thought
but I passed on that, yeah.
Got it. So let's talk about insurance companies. What is the first thing that you look for? Why'd you pass on Gainsco? And what makes a good insurance company? 3 questions right there.
I looked for a long history of a low combined ratio.
Okay, what's a combined ratio?
A combined ratio is just the insurance industry reverses the normal profit margin thing. So same as the railroad industry, they do the exact same thing. So they use a combined ratio, which is their loss ratio and their expense ratio together. You add them up and you get a number, which if it's less than 100, 100 minus that number would be your underwriting margin. That would be how much money you make for each dollar premiums you write. And so like if you had a combined ratio of 95, that would mean that you make 5% underwriting margin. That's the way that like other industries talk about it. They say 5% margin. You combine the two things though, which are the expense ratio and the loss ratio. So some companies might have an expense ratio of 60% and a loss ratio of 35%. That's how they get to 95. Or you could have, a 50% loss ratio and a 45% expense ratio. It's the same combined ratio, but it's a different structure to your costs.
Okay, so why'd you pass on Gainsco?
Gainsco has very limited information available about it. It has not an incredibly low combined ratio, and it has some. I think it has some possibly some investment risk. Okay. So it owns some low investment grade corporate bonds and stuff like that.
Okay.
Yeah. And
what makes a good insurance company from like an investing standpoint?
Oh, from an investing standpoint, having a good example is on the website, Focus Compounding. The write-up that I have of an insurance company is one from years ago, but it's Progressive, which would be probably my favorite insurance company.
Okay, why?
So Progressive. Well, first of all, it's an auto insurer, which is my favorite category of insurers, probably. Probably, yeah, most likely.
Which Gainsco was an auto insurer?
Yeah, but a different kind of auto insurer.
Got it, okay.
Mm-hmm. And Gainsco just focuses on very high risk, actually minimum coverage, basically. People who just want the minimum coverage because it's required by law in their state. It's their big business, yeah. But so Progressive does all sorts of different stuff. I mean, it started out in the higher risk area, but it's spread into doing all sorts of stuff. It's one of the biggest ones. And it has it takes very little investment risk.
Okay.
It makes a lot of money just from underwriting. So it takes a lot of underwriting risk, though. It does. So it has very substantial leverage. Capital is leveraged very substantially in terms of the amount of premiums that it's writing.
And how are the retention rates? Because obviously, I mean, we've spoken about on the podcast insurance companies before, and we talked about Geico and how Geico has pretty exceptionally high customer retention rates.
That's their one problem. Progressive's one problem.
Is that they don't?
Better.
Oh,
yeah. No. I think Progressive's financials will be far better than Geico.
Is Progressive the one with the swan?
The swan?
Isn't there like a swan symbol?
That's Aflac.
Aflac,
That's
yeah. Duh. Oh, yeah, duh.
Aflac is an interesting company, but not for its U.S. operations. It has a Japanese operations. Interesting. But
a duck.
But
we got that question the other day about would you rather fight a horse-sized duck or 100 duck horses or something like that?
Yes.
Or a horse's size of the duck.
Right.
Anyways, proceed.
So Progressive, their retention rate isn't as good because of the kinds of people that they're insuring, really, and also because they're not bundling it. That's their big thing. They want people to bundle with their like renters insurance or their homeowners insurance. But Geico had much higher retention rates because of what they started out in. Older people, married people, certain different things like that have much higher retention.
Young single people. I have Geico.
Young, you have Geico? Okay.
I have Geico.
Yeah. But your profile is not generally someone who would have a high retention rate.
Yeah.
So
sure. Okay. So what about Progressive though? Do you like? So they have
everything else about it. That's their only reason why I think Geico has better. Geico has better results than Progressive on a bunch of measures, like in their financial performance, or as good in their financial performance for 2 reasons. One, their investment is better. because they actually do invest a lot in stocks and stuff, whereas Progressive doesn't take those kinds of risks. And then secondly, they have a higher retention rate. I think that otherwise Progressive would be the better business.
So what does Progressive do with their float?
Invested in very, very short-term government, nearly cash equivalents, like very, very short-term compared to all other insurers. Most all other insurers, they're very, very short.
Why does Geico do stocks and Progressive?
Probably the history of Warren Buffett and
like
stuff, I would
Lou
assume,
Simpson.
with Lou Simpson, yeah.
Yeah.
And Progressive made an active decision to avoid taking like any sort of investment risk. Like I said, they take high underwriting risk though, so it probably helps them take more underwriting risk. They feel more confident doing that if they're know that they aren't taking investment risk at the same time.
So when you value insurance companies, do you value them on like a PE basis or like a cash flow basis? How do you typically think about that?
So with Progressive, what we valued it based on their premiums and their float, broke it down to the two categories, which are one, what's your underwriting profit going to be, and then two, what's your investment profit going to be. At the time we were analyzing Progressive, because they invested all in short-term government stuff, or a lot of it in short-term government stuff, they had almost no income from the investment side, right? So what we did is we valued it based on the idea that eventually they would make more money off of that as like short-term government bonds and things started to yield more when interest rates rose, which they did, and then they made a lot more money from that. And the underwriting thing is just you take like an average over a long period of time, so we assumed some sort of combined ratio. Their target historically has been 96% for Progressive.
Wow. Okay, so we have high customer retention rates. Is there anything else that you like to see? I guess sort of like an intangible quality of an insurance company that would really stand out to you of it being a good sign of a good business?
Yeah, I mean, like in the case of Progressive, for instance, I think their underwriting is better than other auto insurers.
Why do you not like other insurance? I guess, like, why is it auto lenders? Is that what the type of
so there's
auto
two sort of
insurance?
advantages you could have. One, you could have a lower expense ratio. That's like a sustainable advantage. There's something about your expense ratio that you can keep down. Or two, you could have some sort of underwriting advantage. Generally, your underwriting advantage is only going to be in certain niches, and they do exist, but they're small. Whereas the things that people bring to us that are like suggest an insurer that I kind of pass on usually are things that I think the risk is too easy to analyze. So I think that it's very difficult to have an advantage writing certain kinds of risks if it's too easy for anyone to figure out what the appropriate rate is for that. In those cases, it has to be an expense advantage. So if it's like life insurance or something, you need to have an expense ratio advantage, because I just don't think that you can realistically have an advantage in terms of being better able to know what your losses are going to be.
So what is a good insurance company for people to study?
If you go to the website, you can read the Progressive write-up, which is very long, and I think Progressive as a business, regardless of the stock price right now, as a business, it's one of the best insurance companies around. You also can, for a niche sort of insurer thing, you can read the letters that I sent to the Board of Bank Insurance, which was a niche insurer in a sort of specialty product. And they're the reverse situation. They had a very low loss ratio. So they charged a lot for their premiums versus the actual losses that they'd have, which is more common with that kind of insurer. And those are kind of the two kinds that you can have, you know. A general sort of thing like Progressive, which is all about having low expenses, just like Geico is.
Yeah.
You know, and you can also compare them, because Buffett talks a lot about Geico, and you can find things in their history about Geico. So I'd compare Geico and Progressive.
Got it. Cool. And that is on the Focus Compounding website, the Progressive Report. So make sure you check that out. Check out our podcast, 150 different episodes. Hit that subscribe button on our YouTube. Go check that out. We have a bunch of videos. And make sure you follow us here on IGTV. We will see you in the next video. Take care.